The top 3 dividend stock for the month of September. Welcome back to another video here at FiscalVoyage. My name is Felix, and in this video we're going to talk about the top 3 dividend stock for September. These are 3 companies that I personally own for my portfolio, and I'm very happy with the position. They pay great dividends, a very safe dividend, and their earnings are expected to be much higher in the next year or 2 years. Before we get started with the top 3 stocks for September, make sure to look at my description. There's a free ebook, a link to a free ebook, so make sure to check that out. All right, the first top 3 stock for September is Bistro Myers Squibb Company. Right now the company goes for $60.80, and you can see here earnings is expected, forward earnings is expected to be $6.26, giving the company a current forward PE of 9.94, with a nice dividend yield of 2.89, which is almost 100 basis points higher than the S&P 500. So let's look at the fast graph for this company. You can see here earnings there's been times where earnings have been down and also growing, and then down here between 2012, 2013, 2014. But in recent years, you can see here earnings has been growing substantially. In 2016, it grew by 41%, 2017 by 6%, and 2018 32%, and 2019 18%. And this year, their expected earnings is expected to be 33% here at $6.26, and then 2021 19% growth. So if we lower this time period here, you can see here the company tends to follow, I would say, more or less in between the earnings PE of 17.9 and a normal PE of 23. But if let's shorten this time period to get more accurate earnings, you can see here based on the past 4 years or so, earnings or normal PE is about 18, and the earnings or the PE ratio to growth of 21.8. But I like to be conservative and be around the 18 PE. And if we were to go to that normal PE, you can see here the total annual rate of return has a 46% projected total return, or annually total return, for the next 2 to 3 years, and that's outstanding. So in basically in almost a year and a half to 2 years, you could hit almost 100% total return. So that's great. That's why this company, Bistro Myers, is the top 3 stock for September. And as you saw earlier, it's down about 2%, so around $60. This was yesterday's closing price. You can see here the blended adjusted earnings yield of 9.22 was very attractive compared to a 6.5 or 7 earnings yield, which is like my minimum criteria, and a nice dividend yield of 2.89. S&P credit rating of A+, which is investment grade, and a decent long-term debt to cap of 44%. And if we look at the Yahoo analyst scorecard as well, we can see here the average estimate at $6.26 for 2020 and $7.41. So these are different analysts predicting more or less the same amount of expected earnings for 2020. And you can see here the next 5 years, analysts are expecting about 18.40% growth in earnings. So that's outstanding. If we go here back to fast graph, you can see estimate is about 14.65 expected earnings. So even if the company has a PE around 12, you could have a total annual rate of return of 33% in the next year or so. And if we were to extend that, about 17% total annual rate of return until 2023. So that's excellent growth. So this is why Bistro Myers is number 1 in the stock for September to consider. My second stock for the month of September that's very undervalued, and I actually did a video on this company a few weeks, I think last week ago. Put that in the icon here, which is ticker symbol BTI, British American Tobacco. The company right now is going for $33.98. And you can see here, earnings is expected to be $4.20 for 2020 with Seeking Alpha. And the company has a very nice yield of 8.02%. So earnings is at $4.20. Fast Graph is expecting earnings about $4.33 for the year. So you have some varieties of expected earnings. Yahoo doesn't have an estimate, so we'll skip this for Yahoo, but they do predict earnings growth of about 5.2%. As you can see here, the yield almost 8%, which is outstanding, and the blended adjusted earnings yield of 12.67, which is also outstanding. It's an investment grade company at BBB plus. Long-term debt to cap is only 47%, which is reasonable. And you can see here the company is very undervalued based on the Fast Graph. The company tends to average about a normal PE of 15 or 15. If we extend this chart to a longer time period, you can see the company tends to more or less be around the 13 and 15 PE ratio. And right now we have a nice blended PE of 7.89. So that's very considered very undervalued based on its average. So if we to shorten this, you can see here normal PE of 13, because in recent years it's been down, the stock. If it was to revert back to the mean of around 13, you can have a total annual rate of return of about 40%. So that's great, which is include the dividend and capital appreciation. And just in capital appreciation, in the next year or two, you can have 100% return on capital appreciation if the company were to go back to a PE of 13. And if we look at forecasting, analysts are expecting about a growth of 7%. Considering Yahoo is expecting about 5, so I'll stick with around 5%. I like to be conservative there. And you can see here, if we to go here with a P of 10, you can have a total annual rate of return about 38.57. So that's a real good return. And even if the company were to just stay kind of flat around the 9 PE, you have a total annual rate of return of about 24%. Because earnings is growing, you can see here, a growth rate of 7%. Here, an increase year-over-year change for 2020 versus 2019, 4%, 2021, 6%, 2022, 8% growth. So that's real good. And you can look here, analysts last 3 months ago, or 3 months ago, they had an earnings of $4.16. So they actually increased it, since the company reported earnings for the second quarter. They increased it to $4.33. This one for 2021 as well, they increased it from $4.48 to $4.59. So that's very positive. I like to see, that happening when as companies start to announce earnings for, first quarter, second quarters, and then eventually third quarter coming soon. And if we go back to the chart here, you can see the company has been growing earnings very nicely. They had a down year in 2008, a 15% decrease in earnings, as well as in this time period here around 2014, 2015, 2016, earnings was down 10%, 5%, and then it picked up slightly by 1%. But it's grown 28% in 2017. You can see that jump there. But not sure what happened exactly, but at that time period, the stock dropped tremendously in 2018. And this is when I bought shares. As you can see here, I have about a cost basis of around $34.51. So I'm slightly under, but not really. I'm under in capital because I've been collecting dividends. So my total rate of return has been 8%. But as you can see here, I'm down 5% in capital. But I've been collecting dividends. And so my total annual rate of return is 4.6 for now. Again, this company, I expect it to go higher in the next year or so. And if I was to look at that from my time of bought the shares, you can see a total annual return about 22% for the next, basically since 2018 I bought shares. So a nice annual rate of return of 22% with a nice dividend and a growing dividend at that. Is very outstanding. And the third dividend stock for September you guys should look for is Group, ticker symbol UNM. It's an insurance company. Right now the price is up 2% at $18.86. Earnings is expected to be $5.19 with a PE of just 3.56, which is very, very low. It has a price to earning ratio like it's going to be bankrupt. Yield a very nice 6.17. If we look at the remember this is $5.19. You can see here Fast Graph is expecting $5.20. and Yahoo is expecting $5.19 as well. And then in 2021, $5.34 for earnings. And Yahoo is expecting about a 9% earnings growth for the next 5 years. And FastGraph is expecting about 2.6% earnings growth for the next 2 to 3 years. But if we look here at the fast graph, you can see the company tends to follow the blue line, which is the normal multiple of 9. And I added this custom valuation ratio of 5. Even if the company never hits this 9 PE, currently, you can see here, if it was to go back to a ratio of about 5, you have a total annual rate of return of 26.8. And even the 5 PE ratio is still undervalued. But if it was to go back to a 5 ratio, you can see 26.8% annual rate of return. So that's outstanding for such an undervalued company that pays an outstanding dividend and a very safe dividend as well, because we'll look at the free cash flow shortly. But blended adjusted earnings at a whopping 28.5%, almost 30% earnings yield. As you can see here, the blended PE of 3.5. The company is investment grade BBB and low debt to cap at 24%. And if we look at the free cash flow, this is, you could tell the safety of the dividend here. You can see here the dividends has always been well covered by this company. In 2008, they didn't cut the dividend. They actually just froze it from 2004 all the way to 2008. And then 2009, they started increasing ever since then. But nevertheless, this company looks to be very undervalued. We look at the analyst scorecard, which is pretty accurate. You can see they hit 91% accuracy for the 1 year and 100% for the 2 years. So I'm very confident with these estimates. If we look at the forecasting, they were higher earlier this year at $5.27, but did drop to only $5.20, so a 7-cent decrease. Same thing for 2021, it was $5.47. And it decreases to $5.35. So it is decreased, and that's maybe one of the reasons why this company is so depressed from from price expansion. But it looks to be very undervalued. This is why this company is one of my biggest holding, and it's starting to pick up right here. You can see how the uptrend as low as $15 to now $18, and is up today about 2%. So this is why I think Group is one of the my top holdings right now. I stopped buying shares because it's gotten too big in my portfolio. So right now I'm just collecting the dividends and reinvesting elsewhere. But I think in the next year or even sometime this year, this company should be around a PE around 5. And you can see if that were to happen, you have a total rate of return about 53% and an annual rate of return about 37%. Just because of the valuation, and earnings is expected to be higher next year as well as the following year in 2022. So there you have it. Those were the 3 stocks or 3 top stock for the month of September. British Tobacco, Group, and Bristol Myers. Like I said earlier in the video, these 3 companies I hold in my current portfolio, and I'm very happy with the current position. I personally am not adding more because they're a big position in my portfolio. They're about 3 to 5% of my portfolio. I like to keep companies under 5%. So I'm very happy with my current position, but I think these are stocks that you guys should definitely look into. 2 of them pays very, very nice dividend. Bristol Myers pays a nice dividend around 3%, but all 3 companies has a safe dividend that's been growing for years. So thank you for watching, and make sure to check out that free ebook in the description. And if you're new to this channel, make sure to hit that subscribe button, and you like the video, hit that like button for the YouTube algorithm. And I'll see you guys in the next one.